Hello friends, a very warm welcome to my channel. In this video, we are going to do the analysis of Redington Limited, which is a very unique company, one of a kind company listed on the Indian stock exchanges. It's into the distribution business. If you're new to the channel, please do subscribe and hit the bell icon so you get all the updates of the new videos uploaded on my channel. And if you have not got into our Telegram channel yet, please do join the Telegram channel where we discuss lots of news, views and analysis on a daily basis. So Redington Limited is a technology-focused distribution company. It enables the greatest brands in the world to seamlessly distribute their products and services in India as well as various countries abroad. It started in 1993, its operations, and presently it has grown so big that it's a 7.7 billion revenue company. It has 245 international brands working with them, and they are spread into 37 emerging markets which have lots of scope of business. They have more than 200 warehouses and around 4,000 people working with them in their company. This is a professionally run company. There are no promoters to this company, and the chairman of the company is an independent director, Mr. Professor Ramachandran, and the managing director is Mr. Rajiv Srivastava, and the global CFO is Mr. S.V. Krishnan. So it's a professional company with a well-experienced run board managing it quite well. In terms of geography, if you see, it has presence in India, it has presence in the Gulf as well as in the African countries. Now let's talk about the history of the company. They started operations in 1993 by IT products distribution in the western and southern part of India to begin with. In 1994, they started distributing products of Epson and Samsung, and they also ventured into North India with their operations. They also started services business for their IT products. In 1995, they started distributing products of Compaq and Philips. So as we go further and discuss the history at various points of time, you see a lot of big brands across the globe will get associated with this company, and they started operations in East India in 1995. In 1996, they started distributing products of Intel. In 1999, they incorporated a subsidiary in Gulf and the Middle East to cater to the Gulf region as well as the African markets. And in 2002, they commenced the call center business for Compaq. In 2004, a company called Cinex Mauritius, which is a PE fund, they invested 36% stake in this company, and in 2005 they ventured into the non-IT business from the IT business, like consumer durables products. In 2007 they got listed on the stock exchanges, and they also started working with Apple, which is one of their biggest customers now. And in 2010 they invested around 49.4% stake in a company called Arena. So during the journey you will observe that there are a lot of companies and PE funds which are taking stake in Redington, as well as Redington is expanding inorganically, buying stake in different countries across the globe. In 2011, again, Standard Chartered bought about 12% stake in Redington. So these kind of investors, when they come in, you get a confidence that the company is a very reliable company. In 2013, they bought 51% stake in Adeo IT Consultant Services. In 2015, they invested in a company called Link Plus, which is an Oracle distributor. And during 2016 to 17, they merged a few companies of their subsidiary companies into Redington, like Nook Micro and Cadenceworth India. In 2018, the company transformed completely from a promoter-driven company into a professional-run company. And in 2020, a company called Aroma Logistics became a fully owned subsidiary of Redington India. So this is the journey of the company. It has been a very interesting journey, scaling up globally in terms of geography, acquiring a lot of companies, and also drawing attention of international investors in the company itself. Now let's talk about the business of the company. Broadly, we can divide the company's business into four categories. It's the distribution business, services business, logistics business, as well as the new emerging businesses in which the company is now venturing into. Let's talk about in detail one by one. So distribution business comprises of the enterprise business, consumer business, as well as the telecom business. So in terms of the product categories, they have broadly divided their business into these three categories. Under the enterprise business, that is mainly related to the IT products which the enterprises require for the setup of infrastructure in their companies, like the networking products, servers and storages, security products, softwares, licensing and subscriptions of various other products. The consumer business includes the consumers which use different products like computers, tablets, printers and other supplies. Now coming to the third category, which is the telecom business. This business includes products like the smartphones and the AR/VR wearables. So other than the smartphones and the AR/VR wearables, the other electronics are included in the consumer category, which the consumers use. So in the enterprise category, they are partners for a lot of global brands like Cisco, Lenovo, Jupiter, Luminous, Microsoft. So there are plenty of different global brands partnering with them in the enterprise business. In the consumer business again, which is the products used directly by the consumers, all the popular big names like Acer, Amazon, Canon, Dell, Epson, there are all popular brands included in the consumer business. In the telecom business, they are distributors of Apple, Google, Jabra and Motorola. Now coming to the services category. In services category, they broadly provide three categories of services, which is the cloud migration services, the 3D printing services and the HP Indigo services. So they don't do the service on their own. They help the customers establish their service business. They help the clients to migrate their business applications to the cloud. They provide the backup and storage services, the website services and the video conferencing services related to the cloud. In the 3D printing, they enable the clients to use the 3D printing technology to manufacture and design the automotive parts. Coming to the HP Indigo printing business, they help the various commercial printers establish their printing businesses. Now let's talk about the partners in these kind of businesses. So in cloud, they have partnered with AWS, Freshworks, IBM and various other global brands. In 3D printing, they have partnered with Zeiss and HP. Now coming to the third business, which is the logistics business. This one is done through a wholly owned subsidiary, which is Preconnect Logistics. Under the Preconnect Logistics business, they provide various logistic facilities or services like third-party logistics, which is a normal logistics services, reverse logistics, which is from consumer to the sender, in-plant logistics, which is within the movement of the plant location, project management, supply chain consulting, mission critical logistics, which are for the urgent orders, e-commerce and transportation, regular transportation services. So in this business, they have more than 165 warehouses. They work with over 65,000 SKUs and they serve more than 36,000 plus customer locations. Coming to the last category of their business, which is the emerging businesses. These are businesses which the company is now venturing into. They are expanding into the health and medical category, covering various products in hypertension, eye care, liver and various things which are listed on the screen. And another interesting business they are getting into is the solar business. In solar business, they are tying up with global brands and importing products which are related to the renewable energy and distributing it to various locations of the world. Now let's talk about the brands with which they are associated with. In health and medical, they have already partnered with brands like Bosch, Omron, Philips, etc. In the solar business, they are selling solar PV modules as well as solar PV inverters. For the modules, they have distribution with JA Solar, Longi Solar, REC Solar, which is one of the biggest companies in the world. And in the PV inverters business, they are distributing GrowWatts products. When you look at the revenue by geography, they get about 43% of revenue from India and about 57% of their revenue comes from abroad. In terms of verticals, 1% of the revenue is by services, 32% from mobility business and about 67% from their IT distribution business. If you see the top 5 vendors which were providing maximum revenue to this company, Apple provides 35% of the revenue, HP about 12%, Dell about 9%, Lenovo about 6%, Samsung about 5% and other brands about 33%. So this looks attractive that Apple provides 35% of the revenue, but this also comes with the risk that the revenue is concentrated in the hands of a few large vendors. Now let's talk about some trends in the industry which are related to distribution. The work from home trend has increased a lot of consumption or requirements of various gadgets, which is good for the company. The ICT products, which are the information communication and technology product spending, is expected to grow about 5% every year from here onwards. The laptops market is expected to grow globally at a pace of about 6.5% CAGR up to 2025. Various new technologies like the Internet of Things, AI, ML, or AR and VR technologies are increasing the consumption of various gadgets, which is good for the company. 5G would be a big revolution in India, which will increase the amount of smartphones which are used by different people in India, even in the rural areas. And post-COVID, digital transformation by various companies has become a must. Every company wants to go digital, and this increases the amount of network infrastructure, the cloud infrastructure, as well as the gadgets which the companies need for their digital transformation. The worldwide ICT spending, if you see up to 2023, it has been constantly growing in all the categories of hardware, software, services, telecom, as well as the new technologies. Now, who are the competitors of the company? There are no identical listed competitors, but in the unlisted market, there is severe competition to this company from companies like Ingram Micro, Savex Technologies, CompuAge Infocom, RP India, Supertron Electronics, Tech Data India, and there are various unorganized players also which compete against this company. So if you Google the name of these companies and check their websites, you will get to know that they are doing a lot of similar stuff which Redington is doing. Then there's severe competition to Redington. So what are the competitive strengths of this company? They have already successfully well-established presence in more than 37 emerging markets. In all the businesses, in all the markets they are working in, they have in the top 2 positions, which is very good for the company. All the markets which the company is penetrated already into are high potential markets of developing countries, and they have presence across various product categories. They are also further expanding into medical and other solar products. They have tie-ups with lots of big brands across the globe already. So generally these are long-term arrangements, and the brands don't switch to other distribution partners quite often, and they are a tech-driven company. They keep updating their technologies to help them provide better services to their customers. So why would a partner with somebody like Redington and not an unorganized player? Is because of the marketing support which the company provides to the brands. They have regular communication with the brands, giving them feedback about their customers. They provide some credit to their customers to boost the sales. They provide training to their customers on using their products. They provide pre-sale services, giving the brands an idea as to which product can move faster and things like that, and various analytics. And they also have different incentives to grow their business. So these are some benefits which the company gives to attract partners in their business. Now let's talk about the growth strategy of the company. There are different trends in technology which the company is focusing on and gearing up for these kind of trends so that the growth is much faster. They are focusing on hybrid cloud, the 5G technology, the cyber security sector, the digital economy, which is the cashless economy, and a lot of emerging tech products like the smartwatches and various other stuff. There are different business model trends also which the company is focusing on, like there is a shift from product to services kind of a payment where people are trying to pay on a subscription basis. Omni-channel, which is from offline to online business, they are focusing on emerging tech. They are also focusing on hybrid work model. So these are the different strategies which the company is planning for their growth. So what are the growth strategies of the company apart from the ones which we have discussed? Is they want to maintain their market leading position in the existing categories of products which they are working in different locations. They will keep on reinventing their models as per the trends change. They will focus on high tech sectors. As we see, they are diversifying into new products and newer categories. They want to be the #1 distributor across the products, brands and markets wherever they enter in any kind of a market. And in terms of numbers, internally the company has a target of having a double-digit growth in revenue in the coming years. What are the risks to this business? It is very critical to understand the risks to this business before you invest, as this is a working capital intensive business with very low margins. As we've discussed the financials, you get to know that it's a very low margin business, having just a 2 to 3% of EBITDA margin, which is unlike any other business which we have studied until now. There is an inventory risk, as the company carries a lot of inventory. The company has to purchase the inventory just in time. They have to manage their inventory well as per their orders. So there is a lot of inventory risk involved in this business. The risk of receivables, as a lot of times the company works on credit. There is a currency risk, as it's a global business. They have to keep hedging their purchases and sales across the globe. There's also a risk of obsolescence because the company deals in new tech products, and if they are not able to sell those tech products in time, though they will get that technology will get obsolete and people will not prefer to buy those products. Now let's talk about the numbers. Starting with the quarterly results, they have not declared the Q4 results until now. So Q3 results are about 16,600 crores of revenue compared to 16,981 earlier. So it is flattish. EBITDA has gone up from 424 crores to 525 crores, which is a good number. Profit after tax have jumped from 192 crores to 388 crores. EBITDA margin has improved after a very long time from 2 to 3%. Profit after tax margin has also improved from 1.13% to 2.3%. So in terms of quarterly growth, the company has delivered decent numbers. Now let's compare the yearly results of the last 5 years from FY18 to the trailing 12 months in the P&L items. The revenue has gone up from 41,600 crores in FY18 to 60,840 crores in the trailing 12 months. So there has been a steady growth in revenue in the last 5 years, which is good for the company. The EBITDA also has steadily grown from 846 crores in FY18 to about 1726 crores in the trailing 12 months. So there's the decent growth in EBITDA level also. The EBITDA margin has slightly improved from 2 to 3% in the recent year. The profit after tax has gone up from 482 crores to about 1234 crores in the last 5 years, which is a very good growth. The profit after tax margin has slightly improved from about 1.16% or 1.33% to 2.03% in the trailing 12 months. Now coming to the balance sheet items, the equity is the same except a buyback leading to 78 crores of equity in FY21. The borrowings are under control. It has just a debt equity ratio of 0.13. So the debt on the balance sheet as on FY21 is just 622 crores. The trade payables have gone up with the company's business increasing to about 7,300 crores in FY21. Things like trade receivable, trade payables, the inventory levels have to be keenly watched in these kind of companies as this is a trading business. So as of now, as per the revenue trend, this looks fine, but if there is any abnormal movement, that could be a red flag for this company going further. The fixed assets are fairly constant. The company doesn't require much of fixed assets as they have limited warehouses for their transport or logistics business, and most of them might be on lease. So they have just about 600 crores of fixed asset on the balance sheet. So most of their money is locked up in the current assets. Inventory has fairly range bound from about 3,300 crores to 2,900 crores in FY21. So this shows that in spite of the turnover increasing, they are maintaining a decent amount of inventory only. Trade receivables have increased from about 5,000 crores to about 6,800 crores. This is fairly in line with the revenue growth in the company's financials. The cash equivalents have gone up to 3,493 crores, which is a very good sign, and this has been a cash-rich company all the while. The operating cash flows have always been positive. They delivered a massive operating cash flow of about 3,497 crores in FY21, which is very impressive. Free cash flows have also been positive, and they have about 3,500 crores of free cash flows in FY21. So in terms of cash flows and balance sheet, the company has a very strong position. The debtor days are fairly under control. The debtor days, the inventory days are also very critical. In spite of providing a limited credit to their customers, in spite of doing close to 60,000 crores of turnover, the company has control over its debtor days, which are just 44 days, which is very impressive. The inventory days have gone down to 20 days, which is again very good for the company. The ROCE is steady and it has risen to about 21% in FY21, which is also a good sign. Now let's talk about the shareholding of the company. The FIIs hold about 39.4%, DIIs hold about 16%, and the public holds about 44% of the shares. So there are no promoters as we discussed. Under these FIIs and DIIs holdings, they are very popular marquee names of institutional investors which have invested in this company. Now let's talk about the valuations which are to be valued a little differently in this company. The last traded price is just about 150 rupees and 52-week high and low is 87 to 179. In the last 1 year, the stock has given 72% return, 3 years 44% CAGR, and 5 years for 20%. So it has given a fairly good amount of return to its shareholders. The market cap is close to about 12,000 crores, and the face value is a 2 share. EPS is about 15 rupees, and the PE comes to about 9.7. Now, a lot of us are wondering that the PE is 9, and this is a very undervalued company, and that is why we should go jump and buy this stock. I hear a lot of discussions about this company on the social media. But if you observe, the 5 years median PE has been 9 itself. So as far as the median PE is concerned, or the range of valuation which this company has been getting in the longer periods of time is fairly the same. So this doesn't seem to be an undervalued company to me, looking at the valuation which the market has given to this company in the past. In terms of book value, the book value is 63, which makes the PB ratio 2.43, and the market cap to sales is again 0.20. Looking at this, we should not consider this misleading figure as 0.20 as a very attractive valuation, as again this is a trading business having huge turnover with a very less margin. So you have to check as a history how much valuation the company has been getting, and compared to that, if the performance is consistent and the valuation is lesser than the history of valuations, only then this stock becomes a attractive stock from the purchase point of view. In this slide, we are trying to understand why the market could have given lower valuations to this company in the history until now, because this is a very low margin business. So the market might not have given higher valuations to this company. There is a lot of competition from lot of big players as well as small unorganized players in this field. There is no strong moat on the company, although they have presence in several countries and tie-ups with several brands, but still this business is easy to penetrate. If any big business house wants to get into this business, it is possible for them to get into business and take away some share of business from companies like Redington. There could be a big loss in revenue if some big customer decides to discontinue their service with Redington, which is a very big risk in this business. And in terms of growth, the growth has been fairly decent, but it's not a very fast growing company, and these could be the reasons why the stock has been given a comparatively low valuation compared to the other companies in different sectors. Now let's look at the chart. The stock has given a very big rally from about 100 to 150 odd levels recently, and thereafter it has entered into a consolidation range. So if you want to get into the stock and you want to get into a fairly reasonable valuation, you should wait for a correction and let it fall so that it takes support at somewhere around 100, and that could be a fairly reasonable valuation to enter the company. At the present range, it could be highly risky, as if it breaks the support of 136, then there could be a steep fall leading to the price levels of 100. So this is about Redington. To conclude, let us summarize the thesis and antithesis points which we have discussed about the company. In terms of the positives, the company has strong fundamentals. It is into a stable business. It has grown into a huge company over a period of time. The business is well managed by competent people in the worst kind of situations, which is very good and very impressive. They have brand partnerships with a lot of big brands globally, and in terms of network of their company globally, as well as the infrastructure and the team, the company has a lot of opportunities and a very bright future. Now, when we look at the antithesis points, the company has not grown very fast. It has been a fairly decent growth. It's a very low margin business. If something goes wrong, the company may enter into losses. It's a highly competitive field, a distribution business. There's not very strong moat in the company. And in terms of valuation, it has always been given lower valuations by the stock market. So this is about Redington. I hope you like the analysis, and this will give you a fair amount of idea to take the correct decision of investing in this company. And if you want me to make videos on your favorite stocks, please do comment the name of the stock in the comments below. I'll surely consider for my upcoming videos. If you have not subscribed to the channel, please do subscribe and join our Telegram channel as well. So thank you for watching and have a wonderful day.